You're listening to the Option Alpha podcast from OptionAlpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at OptionAlpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again from OptionAlpha.com, working every single week to make this the most popular investing podcast offered online and in iTunes because it's based on one thing and one thing only, and that's helping you guys make smarter trades. So again, thanks so much for tuning in today. On today's show, we are going to be answering the question, or basically talking about the question, are you selling options that are way too cheap? And I think it's a topic that we haven't covered and definitely haven't covered in about 102 episodes, but we'll give you guys some interesting insights here and go through a couple case studies, some that we've run through our profit matrix report, and also a real live case study, I guess, at the time that we're looking at the market right now with SPY, just to kind of drive home this point. Now, the background of this, the reason that we're answering this question in this podcast is because I get a lot of people who send in emails, and this is, again, where, pretty much 99% of the content comes from for what we do here at Option Alpha is by people like you sending in questions and getting the same types of emails over and over again. But a lot of times people will ask a general question around this topic, right? So it'll be something like, hey, Kirk, why do we sell options at 70% chance of success? Why not sell them at 90% chance of success, right? So the logic here is, okay, if 70% is good, then 90% is even better. Now, most people know, and it's probably a little bit understanding there that if you sell options a little bit further out of the money, right, and 90% chance of success, that you're not going to make as much on that option as you would if you're selling options at, say, a 70% chance of success. But where is that distinction, right? And that's really the answer that we have to try to come to with most strategies or with most setups is, what is the optimal setting? What is the optimal level at which you should be probably selling options, right? Now, we know that there's no one right answer, so it would be ignorant of us to say, hey, it's at this level. So this is the only level that you can sell options at, right? The reason that we built the trade optimization and backtesting software is so that we could figure out what that level is for different case scenarios and different market setups. But there is a distinction between selling options at 70% and then 90% and the premium you collect and the win rates that you have. And there's a big difference as you sell further and further out of the money. I think the issue that I have is that most people who trade at the 90% probability of success level are just not collecting enough premium or money to make it worth it. Now, granted, they have really high win rates, in some cases 90, 95% win rates. But when you factor in commissions and all the trading costs that are associated with it, they're not really generating a lot of cash, a lot of actual money return in their account. And so that's something that I want to kind of cover today so you guys have a little bit of a better understanding of, maybe where that range is for you, at least to give you some idea of it. And also, again, to go over one of the case studies from our Profit Matrix report that we released. So first things first, I want to kind of cover and just show you guys an example of what's going on right now with SPY, just because I think this kind of proves the point of how options are priced. And it's not just a simple linear, I guess, calculation as far as how these options are priced the further you go out of the money. So it's not, hey, once you go 10% more out of the money, then it's, 10% drop in premium. It's not like that. It's actually an exponential drop off in premium. And so there has to be somewhere along that curve, that equity curve in premium and risk and reward that could be more optimal than not, right? That's the idea that we're trying to figure out. So let's use SPY just as a case study for this. And at the time that we're recording this video, we're just looking at the September call options in SPY. And so right now, if I look at the September call options, which are about 60 days out right now, we have the 40 deltas that are trading for $235, right? So there's the 40 deltas, right, which are just slightly out of the money. Remember, a 50 delta would be basically an at the money call option, but we're starting just slightly out of the money. A 40 delta call option is trading for $235. Now, to set that up as the basis for our analysis to say how much premium reduction do we get every 10 deltas that we go out of the money, we're going to now look at the 30 deltas. So the 40 deltas were trading at $235. The 30 deltas, so we're basically moving out 10 more deltas, effectively 10% more out of the money, right, on a probability basis. The 30 deltas are now trading for $140. So it's about a 40% drop in premium going from the 40 deltas to the 30 deltas. Okay. Now that's the first one, right? So you're thinking to yourself like, okay, that's a pretty significant drop, no doubt, right? We're basically cutting 40% of our premium. But on the other hand, we are increasing our probability of success effectively by about 10%, right? So that's, kind of where we're at. Now let's look at the next 10 delta move. So now looking at the 20 deltas. So again, now selling options further out of the money, going all the way out to the 20 delta options, we see that the premium goes down to $75. So the difference now between 30 and 20 in premium was a 46% reduction in premium. So now we're starting to build this context. And again, it's not always going to happen like this with these exact numbers. So please do not email me or comment and say it doesn't always exactly happen like this. I know that. This is one example of it, but it's proving the concept that as we continuously go further and further out of the money, these option values and premiums drop at a more significant rate. So the difference between 40 and 30 deltas was 40%. Now the difference between 30 deltas and 20 deltas was 46%. Okay, so the premium went from 140 down to 75. That's again a pretty significant drop. Again, just to be fair, now that we continue to go further out of the money, we're increasing our probability of success, but we're sacrificing the premium that we collect. Now again, there's no right or wrong answer like on the outside here. If you want to trade at the 20 delta or you want to trade at the 30 delta, by all means, just understand the trade-off that you have in going further out of the money. You're sacrificing your premium at a faster and faster rate, the higher you increase your probability of success or your targeted probability of success. So let's look at the last jump here. The last jump here basically is from the 20 deltas to the 10 deltas, right? So now we're going from, say, an 80% chance of success to a 90% chance of success. The premium in this case drops from 75 down to 26 at the 10 deltas, which is a 65% reduction in the premium for the next additional 10 deltas that you go far out, right? So now we have this this increasing progression of premium decay, 40% for the first 10, 46% for the next 10, and 65% reduction for the next 10 deltas. Right? You can see that premium is eroding at a much faster pace the further you go out of the money. Now, the question becomes, why is this the case, right? And I think on the outside, theoretically, the reason that this is the case is because people know that the further and further you go out of the money, just the less likelihood that that level is going to be hit. You start going to a 1, 2, 3 standard deviation type level where the market just knows that the likelihood of getting hit at that level is so small that the value of those contracts just kind of fall off the map, right? And it's no different than like a lottery ticket, right? A lottery ticket has almost no chance of getting hit, right? Like a so small chance of getting hit. And for winning, so we know that it's just $1 or, whatever it is, in some cases, 50 cents, 75 cents, whatever it is, right? I don't buy lottery tickets, so clearly I have no idea. I think they're pretty much $1, right? But it's just that same concept that the further and further we go out of the money, the options market's smart enough and the participants are smart enough to know that there's probably an even smaller chance of getting to that level. So they're not going to associate a lot of value for those contracts, right? So now we know, at least on the outside here, that we have to take some sort of risk, right? That's really the key here, is that we have to take some sort of risk. We have to, find this happy medium. And again, it's different for every person, but we have to find this happy medium of risk and reward where we come in close enough to capture enough premium, but we're just far enough out that we actually have a significant win rate, right? I have always said, and I've said for a long time, that I like the 70% chance of success level. That's about if you're doing a one-sided trade, a 30 delta. If you're doing a two-sided trade, it's a 15 delta on each side, right? But I like being around that range. That to me is comfortable. I think it's a comfortable win rate. I think it's a comfortable premium rate. I'm not too close. I don't have, huge drawdowns. That's where I like to kind of hang out. And a lot of our back testing, thankfully, has kind of confirmed, most of what we say there. So now let's do this. And I want to take it like one step further. Now, this is just one example of one contract month, right? So I think what you really have to ask yourself as you get further into options trading, if this is something serious that you want to do, is you have to really optimize these trades kind of on the fly for different time periods and different implied volatility levels. And again, I'm saying this because we built software that did this, which is a couple $100 and you've got lifetime access to it. So it's ridiculous not to get it. But if we ran a scenario now, and I'm just looking through our profit matrix report where I was looking at just short strangles, right? So I basically looked at all the analysis that we did on short strangles, 60 days to expiration. So effectively, what we're kind of looking at here with SPY, generally low volatility, right? Not insanely high, 60 days until expiration. If you wanted to do something like a short strangle where you're selling options on both sides, what we did on the SPY example just now was just looking at the call options, but the put options have very similar types of behavior in their premium. But if we want to put on a short strangle, what is the best delta to put on? Now, we ran analysis and we've got basically like the top 20 here that we see on our end. And in almost every single case, no matter what the little like tweak that you made to the strategy was, the best delta when you're 60 days out for a short strangle is around a 0.2 delta, a 20 delta on each side. Now, I would have effectively said in most cases before we had this research that it was probably a 15 delta on each side because that's what I'm comfortable with. But now that we know this, now we know, okay, in most cases, like in this case, we have 20 scenarios here. I think 16 out of the 20 had a 20 delta on each side as being the most optimal delta. That's really powerful information now. Now I know, hey, when I'm 60 days out, I should come in just a little bit more and I'll be more than compensated for that additional risk in my position, maybe losing a little bit more by the additional premium that I collect. Maybe, two times more premium, whatever the case is, right? So that's where I think this topic and hopefully this conversation is going with you, and you're kind of thinking about this on your, with your own trades is, where's that level where I know I'm going to take a little bit more risk, but I'm going to be more than compensated for doing that. With these options, especially with the SPY ones that we were just looking at, it looks like we should sell about the 20 deltas on each side if we're doing a naked position on this, if we're doing a naked strangle. And that means that we're collecting, maybe $75, $90 on each side, depending on the calls and puts, right? We're collecting a pretty good premium and we're still have a pretty good chance of success. It's probably the most optimal way to win, right? Now, that doesn't mean, of course, that we're not going to have drawdowns, et cetera, because we know we will. We know we'll go through drawdowns in these strategies, right? But these strategies have the highest returns. They have the best Sharpe ratios, right? That's what you want. You want strategies like that have the overall good mechanics of a stable portfolio, right? And so that means that you can't, in this case, sell the most cheap options because it's not the best way to go. So the counter argument to somebody who asks, well, why can't we just sell the 90% chance of success options in this case is that if you sold the 90% chance of success options, you probably had the highest win rate, but you didn't have the highest return. And so the question becomes, what's more important to you, win rate or return? A lot of people live in the win rate, right? This is something I see often too, just to like kind of dovetail on this for a quick second, but a lot of people live in the win rate. They email me and they say, Kirk, I won or I lost and everything's about win, lose, win, lose, win, lose. And by no means am I like not discounting that. It's important that you have a win rate higher than 50%, right? Because you got to get that right first. But what are you winning and what are you losing on, right? And so you show me two people and one person has a 70% chance of success. The other one has a 90. Most people would say, hey, I want to follow the guy with a 90% chance of success. But if the guy with 70% chance of success ultimately ends up making more money, or a strategy like that ultimately ends up making more money, what's more important to you? Is it more important to you to have a higher return in a more stable portfolio? Or is it more important just to have a really high win rate? If it was more important for you to have a really high win rate, just to answer this, I guess, verbatim, then you should sell basically like the 5 delta options on each side, right? You'd collect almost no money. Commissions would eat up everything, but you'd have like, good job you'd have a rock solid, win rate, right? But that's not ultimately, I don't think, what everyone's goal is. And so I hope kind of talking through this today helps you out and just understanding these differences and really, kind of thinking about this in a more advanced, or with a more advanced thought process behind, how you select your different strike prices and really what that premium means. I think what we found in most of our analysis, and you can see this in the Profit Matrix report if you head on over to show 100 at optionalpha.com/show 100 and kind of learn more about this, is that, somewhere around a 1 standard deviation generally is the direction you should be in. But there's always a tweak that you can make based on time until expiration or based on implied volatility where you maybe in some cases should come in closer or in some cases go out further to really kind of optimize your returns. And so that's what I think it's all about. So hopefully this discussion today was really, really helpful and kind of, again, just trying to figure out if you're selling options too cheap, if you're, not taking on enough risk. And in some cases, maybe you need to take a little bit more risk. Maybe in other cases, you need to take a little bit less risk. Okay. So again, really hope you guys enjoyed this discussion and let's get into the trader Q&A segment.
And now our favorite part of the show, Trader Q&A, where we ask a question from one of our current members about options trading. Got a question you'd like to ask Kirk to answer live on the air? Just head on over to optionalpha.com/ask and hit the record button to leave a message. That's optionalpha.com/ask. And now, here's today's question.
Hi, Kirk. My name is Zach. I'm from Southern California and have been exclusively trading options for a little over a year now. A quick kudos to you. Option Alpha is hands down the best resource for new and advanced options traders. I just want to give you some recognition for creating such a phenomenal resource. Question I have is around low volatility environments. I bought Option Alpha's watch list and check it daily for the quote unquote low hanging fruit. But when there's none available, what type of strategies do you employ and on what type of underlying? Stock, ETF, index, etc. Just want to get your ideas or thoughts on that when there really is no low-hanging fruit available. Thanks a lot, Kirk, and keep up the awesome work.
All right, cool. Zach, thank you so much for submitting the question, also for the very kind words coming from Southern California. I just wanted to, answer this question hopefully as simplistic as I can, because this type of question comes up a lot. And I think that most people have this trade analysis paralysis problem where they look for so many different things to line up and for all of these stars to align. And effectively, they analysis paralysis themselves out of making anything, right? They don't do any trades at all. So I am totally of the opinion, and will reiterate, that I think using our watch list software, whatever software you use, you don't have to use ours, but use anything that you have that shows you implied volatility and look for the low hanging fruit. So by no means, or I want to reiterate that I agree with that. Look for the low hanging fruit first. Do that first. High implied volatility, usually ETFs, if you can find those, like gobble up as many of those as you can get right in your portfolio, and then move on to basically like stage two, or like non low hanging fruit, if we want to call that. But the question that Zach asked was like, what types of strategies do you employ with non-low hanging fruit? And the first thing is you still want to employ option selling strategies. So even though implied volatility may not be optimal, meaning above 50% or above the 50th rank, right? That still doesn't mean that the edge isn't present. The edge is still there. You can still make money selling options even when implied volatility is low. In fact, you go back to a lot of our case studies that we've done in like the higher 90s show ranges where we talked about selling options during low implied volatility. We present a lot of case studies where you can make money selling options during low implied volatility. Now, what you have to understand is that selling options during low implied volatility means you should also scale back your position size, because the edge isn't as great as it is during high implied volatility. During high implied volatility, we make, maybe 2x more per trade or 3x more per trade. So we want to scale into those types of scenarios. And when implied volatility is low, we want to have more cash. We want to be a little bit more conservative, right? So that's the first thing that you have to recognize, is that even during low implied volatility with this no low hanging fruit available type scenario, you still want to be selling options. Now, the next question becomes, or the next thing you should focus on is you should try to focus a little bit more on portfolio diversity. So when implied volatility is low, now you really want to make sure that you are, pretty well diversified across this universe of low volatility. So if everything's low volatility, well, then you don't just want to just randomly pick stuff. You want to try to get stuff in a couple different sectors or a couple different areas. As I'm going over to my own platform right now and just kind of looking at our portfolio, and mainly lots of stuff that has low volatility, because that's just kind of the market we're in. We've got EFA, which is emerging markets, FXE, which is the euro. We've got IWM, which is the major markets, IYR, which is real estate, TLT, which is bonds, OIH, which is oil, FXI, which is China, SMH, which is semiconductors, XLF, which is financials, XRT, which is retail, right? Like we've got our hands in a lot of little different things. And I think that that's the way you have to play it, because all you're doing during this time period is you're trying to capture a little bit of income until high implied volatility returns. That's really what you're doing. So I don't consider it spinning our wheels, because we generate money during this period, but it's definitely not the money that we would generate during high implied volatility. We still just need to trade and be active, keep our numbers up, etc. But we want to spread our risk across all these different little areas. And I prefer during these time periods just to focus on ETFs, right? So that doesn't mean we won't make a trade in a particular like stock. And actually, we'll go through this here in the closing bell segment where we talk about a trade. I think that's actually the next podcast that we talk about the closing bell segment and a trade that we made in Apple or Amazon. but those are during high implied volatility. If it's low implied volatility, I generally prefer to stick with the ETFs because I just want to have those like stable industries and sectors in my portfolio and just sell some general premium in there. So the question then is, okay, well, how do you pick from this list? And I literally pick still top to bottom, highest implied volatility to lowest. So even though it's not low hanging fruit, high implied volatility, if something is at a 45 IV rank, I'll go for that first versus something that's at a 25 IV rank, right? And again, this is where you have to have a little bit of subjective, analysis in here that if the top, like 5 things that you're looking at are all oil related, okay, pick 1 or 2, but don't pick all 5, right? You don't need to trade OIH and XOP and USO and XLE, all of these oil energy related things. That's maybe too much exposure right now for that. So maybe pick 1 or 2 of them and then move on to a different sector, right? And just kind of work your way down the list. So as far as choosing strike prices and expirations go, the only thing I can say to that is you have to run the analysis and do a back test on it and figure out what, is the optimal price for that level, that time until expiration, because it could change. You could, if you're doing a strangle versus an iron condor, could have, totally different strike price selections and profit targets or exit targets. I mean, it could be totally different based on, what the research shows. So that's why I say, get the software. It pays for itself in literally 2 trades because it has that analysis kind of built into it so that you know exactly what strikes to select, when to exit, when to get out, when to take profits, etc. It's all kind of pre-built in there for any market scenario. So I think this was a good question. I know I went a little bit longer on this trader Q&A than usual, but I think that a lot of people have this question. So if you guys have comments or follow-up, or if you like this, let me know in the show notes, optionalpha.com/show 102. Again, just the number 102, optionalpha.com/show 102. Again, if you'd like to get your guys' question answered here on the podcast or live on Facebook and Periscope, as I've already been doing, please head on over to optionalpha.com/ask, click the big red button in the middle of the screen, and leave me a private voicemail, just like Zach did. There's no software to download or install, and it's incredibly easy. Now, before we get into closing bell segment, again, if you want to learn more about our options backtesting and trade optimization software called our Toolbox, you can just head on over to optionalpha.com/toolbox. There's a nice little video tutorial there, kind of goes through it, some examples, some screenshots of how the software works. You can even do some demos there. Again, it's optionalpha.com/toolbox.
Now, the closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
All right, so in today's closing bell segment, I want to go through a new VIX trade. And I don't think I've even gone through a VIX trade except for I know I went through in one of closing bell segments maybe a while ago, 30 or 40 episodes ago. We actually did a VIX trade at the time that we were doing this. But today we ended up doing another VIX trade. At the time that we're recording this episode, it's Thursday, and the markets are just kind of all over the map here on Thursday. And I want to get in this VIX trade because I like going short volatility. Now, I'll admit, and I even said this in the trade comments when I went out to members today, that if I lost on this trade, and you probably won't hear other people talk about this on podcasts, but if I lost on this trade, I'd actually be happy. Because if I lost on this VIX trade where we're shorting volatility, that means volatility went up, and that means that there's an insane amount of other better opportunities out there, but we're just starting to see the VIX go higher. And so I wanted to put on this position. It's a put debit spread on the VIX where we are actually buying a put and selling a put at a lower strike. We'll talk about the strikes here in a second, but we're doing this with the intention that, okay, if the markets do reverse a little bit and volatility calms down, which I'm sure it might because I don't think we're at a point now where it's just going to go insanely crazy, then we want to profit from that, contraction and volatility, right? And so again, if we lose on this trade, which I really hope we actually do lose on this trade, that means that implied volatility is expanded and there's tons of other stuff which we can trade, right? So this position is by no means going to kill us if we can get into a ton of other stuff and make, more money elsewhere. So, but it's a hedge against the market kind of reversing course and contracting now, which I think is really, really important, obviously, to, kind of talk about. So right now at the time that we're doing this video, the VIX has been rallying. It was, had rallied. If you're kind of paying attention to the markets lately, last week at the end of the week, it had popped up to around 16, 17, kind of contracted earlier this week. And then now today on Thursday, it's rallying back up again. It's, towards the end of the day here, and we're starting to see the VIX continue to move up pretty significantly. And so again, we don't want to miss this opportunity for maybe another contraction here in the next couple of days or the next week or so, however long it takes. And so what we're going to do is we're going to end up buying the September 16 puts and then selling the September 14 puts. So again, the VIX is trading right around like 15 or so and change. I mean, it's actually kind of like all over the map, even as we get closer towards the end of the day here. And so we're buying the put options that are above the market, so just slightly in the money put options, and then selling the put options that are slightly below where the VIX is trading right now at around like 15 and change at 14. And so the reason that we're doing this is because we know, obviously from our show that we did with Mark Sebastian on the VIX, that it's probably better in most cases, instead of selling a call spread above the market, to actually outright buy the debit spread, especially with these volatility products. You play the actual like directional move lower. Now, in this case, we're going with September's. We could have obviously gone with something a little bit closer, like a weekly, but I wanted to give ourselves as much time as possible to, be right in this trade. Now, the sacrifice that we're making for that is that pricing in debit spreads is not always like it is with regular stock. So with regular stock, if we had something that was trading at $15 and we bought the 16 puts, sold the 14 puts, we'd probably pay somewhere around like $1 for that contract, somewhere, kind of par with a 50-50 bet. But with volatility, we already know that future expectations, volatility is going to go lower, right? So that's already pre-priced in to these securities. So when we buy and sell these contracts, we're actually going to pay a net debit of 145. And that means that we actually need the VIX to go below 14.5. And so again, VIX can move definitely within a day, a couple percentage points for sure. Definitely, a point or two on the actual like raw scale, 14 to 15, etc. So I'm okay taking that bet for the next 30 days. That look, if in the next 30 days, the VIX moves down below 14.5, then we'll end up generating a profit of about $275, right? Assuming we can close it, pretty much for full value. So again, I'm okay with that bet. We know that the markets are already pre-pricing in that volatility will be lower in the future. That's generally how it happens when implied volatility spikes higher. The market pre-prices in that, okay, over time, the, implied volatility might go lower. But all we need is we just need, a couple days of the VIX trading below 14.5, which I think is totally possible in 30 days. I don't think that we're anywhere near at this point with the market, this major like crash scenario that's going to happen overnight. I think we've got to go through, a lot of ups and downs and sideways action before we get to that. So I think the markets will eventually, recover, if not bounce short term here. And again, if we lose on this trade, which I really like crossing my fingers, you probably have never heard somebody say this. And I said this in the alert, so it's not like I'm saying this on the podcast and not in the alert to members. I frankly would love to lose on this trade because that means there'll be a lot of other trading opportunities elsewhere. So I'm okay in this case, if the markets, go really, really crazy and I end up losing, $725 on this trade, I'm okay taking that loss because I know I'll more than make it up with selling premium elsewhere. And so again, it's just like a little bit of a hedge. So I thought it was something a little bit different. So it was something that we could talk about today. And we'll definitely talk about, other trades that we're making this week and next week when we do our news shows. But this is something that was a little bit unique and we're doing it today when we do this podcast. So I figured you guys would enjoy it.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, so I truly hope you guys enjoyed today's show and got at least one thing out of it that you can apply right now to make you a smarter, more profitable trader and investor. As always, you can get additional resources, links mentioned in the show, and some related video training from today's show by going to optionalpha.com/show102. That's just the number 102, optionalpha.com/show102. Until next time, happy trading.